So this is part number 39 of this multi-part video series for positional stock traders. And the reason why I am making this video is because I wanted to discuss with you an unusual situation here. So have a look at this stock. This is KFinTech. As per the SEBI regulations, we are using old chart. This is 18th of November 2024. So we are in May 2025. So it's more than 3 months old data. So we are allowed to use this information. Now have a look at this weekly chart of KFinTech. Tell me one thing. Do you see anywhere here? Do you see a double bottom? Do you see a double bottom? No, right? But if you go to market smith chart, this base is called as a double bottom. That is why I tell you, do not go into the details of how the pattern is created. The definitions are already given in William O'Neill's book, How to Make Money in Stocks, fourth edition. Just read those definitions once. You don't have to memorize them. On MarketSmith, the pattern is already marked for you. The pivot point is already marked for you. All you have to do is to select the stock and buy the stock if it is breaking out on high volume. Now have a look at this base. Why do they call this a double bottom? Maybe because of this. So they will draw the double bottom like this. Yeah, that's how. See, this is one bottom, this is second bottom. Now, how is it that the double bottom is coming at the top? So if I'm looking at this chart on 18th of November, 18th November week, how is it that the double bottom is coming at the top? The name itself has got the word bottom. How can double bottom come at the top? Moreover, if you read the definition of cup with handle and double bottom and saucer with handle and cups, you will understand that these are patterns which come in the early stage base. So remember, there are three stages of a confirmed uptrend: early stage, middle stage, late stage. Early stage is base 1 and base 2, middle stage is base 3, late stage is base 4, base 5. I have also seen stocks which have gone up to base number 10, but base number 1 and 2 are called as investable bases. Base number 3 is called a tradable base. Base number 4 and 5 are called late stage bases. The probability of losing money in a late stage base is 80%. It's written in the book written by William O'Neill. Let me repeat that statement. Write it down. The probability of losing money in a late stage base is 80%. So the probability of making money after a late stage base breakout is only 20%. Note carefully, listen to what I say carefully. I am talking about probability of losing money. I am not talking about probability of the trend ending. So, for example, this is base number 4, right? So, the stock might break out, it will come down, it will hit your stop loss. So, you have lost money, and then it will start to go up to form another base, which is base number 5. So, the trend has not ended, the trend is still intact, but you lost money. So, the probability of losing money is higher, but the probability of trend ending, that I don't know. That I have not read anywhere in the book. Okay. So there is a difference between probability of losing money and the probability of the trend ending. Okay. Probability of trend ending is maybe small because I have seen stocks which have gone to base number 9, 8, 10, right? So the stock could continue to go up, but the probability of losing money increases as you go into the late stage basis. Okay. Why does this happen? Why is it that at base number 4, you have a higher chance of losing money? By the way, what is losing money? When your stop loss gets hit, that's how you lose money, right? Why is it that in late stage basis, the probability of losing money is higher? Well, the answer is very simple. People who bought at base number 1, 2, and 3, they are the ones who are selling there, right? Maybe they are tired with too long a base formation, because a base like this double bottom, maybe it takes 3 months. So people who bought at base number one, base number two, they might experience that their patience is getting tested. So they might want to get out at base number four. By the way, this was base number four marked as a double bottom, which is extremely unusual. Double bottom generally comes in base one, base two, because these are longer patterns. Double bottom, cup with handle, saucer with handle, and a normal cup without handle. These are patterns which take a lot of time to form, and they are generally formed because of the decline in the or the correction in the general market index. Okay, when stocks come out of a cup with handle, double bottom, saucer with handle, or a normal cup, that is when they go into stage base number two, base number three, which are mostly flat bases or ascending type of bases or high tide flags. Okay, so you have to understand there are some bases which are more likely to come in early stage. There are some bases which are more likely to come in the middle stage. Okay, that does not mean that a flat base is safer than a cup with handle. Well, a cup with handle has got its own advantages. It has got its own pros and cons, and a flat base has got its own pros and cons. A flat base comes in base number two or base number three. So probably people who bought at base number one might want to sell. That's the problem with flat base. The problem with cup with handle is you are buying it very early, right? So the stock might not yet be ready to make that climb unless the relative strength is very high. Unless it's a properly formed base, the probability of it going up is low. You have to understand that. Okay, you're probably buying it early. You still don't have that confirmation. With a flat base, you already have the confirmation. The stock is in a strong stage two confirmed uptrend. Correct. So this is a double bottom. So the high of this candle becomes the pivot point. So 1164.15. So let me take out my old school calculator. 1161.15. So let me first delete this. 1164.15. So let's draw that. I do this in every video so that you also get used to it. 1164. Let's do 1164. Okay. Why to write decimals? 1164 multiplied by 1.05. 1222. Okay. See, this is a weekly chart. The decimal points really don't matter. Okay. So that's the buying range. That is why I keep telling you, don't go into the details of the the base formation. It's already marked for you. You are paying to market smith. Okay, why would you do double uh, analysis? And by the way, look at the number of red bars inside this base. How many of them are high volume? One, two, three, four, five. Out of five, only one is showing high volume, right? And that too, the price is closed above the 10-week simple moving average. So not a big problem, right? Out of five, only one is showing high volume. Not a big deal. So that's the pivot range, the buying range. Let's draw the selling range. I just enjoy doing this process, over and over again. Every video I do this. So this is 1164 multiplied by 1.2, which is 1396. And this is 1164 multiplied by 1.25, which is 1455. That's it. And then the stop loss range. So this is 1164 multiplied by 0.92, which is 1070. I'm not using the decimals, okay? 1164 multiplied by 0.95. This is 1105. 1105. Let's give it a red color. Okay, done. Buying range, selling range, stop loss range. Okay, let's see what happens. when you go to execute the trade. Remember, your probability of losing money here is 80%. Okay. Now, double bottom is a very reliable pattern. It's a documented pattern. 100 years of stock market history was studied. Okay. Difficult to identify, but since we have Market Smith, we don't have to worry. We are taken care of. Okay. So let's go ahead. I will click this once. That is Monday. So Monday, Tuesday. So Tuesday, the stock enters the blue zone. Okay. Now look at the volume on Tuesday, which is 3.11 million. The average volume is around 4.38 million. So let's say the average volume is 4 million in a week. So 4 million in 5 days. So per day, how much are we expecting? 4 divided by 5, which is 0.8 million, right? So in 2 days, how much are we expecting? 0.8 million on Monday, 0.8 million on Tuesday. So 1.6 million. 0.8 multiplied by 2 is 1.6 million, right? But by the end of Tuesday, we are expecting 1.6 million volume. How much are we getting? We are getting 3.11. Look here, 3.11. So almost twice of what we are expecting is what we are getting here, which means this is going to be a high volume breakout week. High volume breakout week, provided it closes above the pivot point. Pivot point is 1164, the high of this candle. Okay. So we are almost sure that this is going to be a high volume week. We are almost sure that this is going to be a breakout. Okay. For a breakout, the week has to close above the pivot point. Okay. If the week closes below the pivot point on high volume, that's a fake out. That is not a breakout. Okay. So Wednesday. So here you would buy 50 shares. Remember, you have to buy shares in three tranches, 50, 30, 20. Whatever shares you plan to buy based on your position size, you would first buy 50%, then you would buy 30%, then you would buy the remaining 20%. So you already bought 50. So Wednesday gone, Thursday, Friday. Okay. On Friday, you buy another 30, or probably, let me do it again. Okay. Monday, you don't buy anything. Tuesday, you buy 50 shares. Wednesday, you don't buy anything because the price is below the pivot. Thursday, you don't buy anything because the price never went into the blue zone. The high went up slightly, so probably the stock went up in the blue zone again. Okay. So you probably got the chance to get 30 more shares. But definitely on Friday, the price went up very near to that upper end of the blue zone. So which means on Friday, you could have accumulated the remaining 50 shares. And the stock has closed above the pivot point. Okay. The closing is 1163.75. The high is 1164.15. It's fine. It's closed at the pivot. That's okay. No problem. The important thing is the volume is above the 10-week simple moving average of the volume. So generally, I would consider that as a proper breakout. For me, breakout is more to do with volume. As long as the price is at or above the pivot, we are fine. So 1 rupee difference on a weekly time frame chart doesn't make much of a big deal. We can consider this as a breakout. Or if you want to be ultra conservative, don't consider it as a breakout. Don't buy all the 100 shares. Maybe stick to uh, 80 shares or maybe 50 shares. Another point I would like to tell you is that uh, for a legitimate for a good breakout, the actual volume should at least be 50% more than the average weekly volume. This is what is written in William O'Neill's book, 50 to 100%, if I remember correctly. I don't remember the page number, chapter number. If the actual volume is 50 to 100% higher than the average weekly volume, it is considered to be a good breakout, which in this case is not true. The average volume is 4.61. So 4.61 multiplied by 1.5. So the actual volume should have been 6.91 million. Here it is 5.45 million. So this is not a legitimate or proper breakout in terms of William O'Neill's experience. He would want this line to be comfortably above that blue line, 50 to 100% above the uh, average weekly volume. 100% means the actual volume is double the uh, double the average weekly volume, right? So it is 100% above the average weekly volume. That is what you would expect, but that did not happen here. So this week, although it represents a breakout, high volume breakout, but still carries that risk. Okay. In good thing about this base is that there are tight closings here, one, two, tight closing here, one, two, another tight closing here. That is fine. Okay. And the red bars, they are coming on low volume mostly. Okay. And that too, it's a double bottom, clearly marked base. Let's see what happens next week. Stock continues to go up. I will move it forward. See, the stock never comes and closes below the pivot. Remember how to make money in stocks, written by O'Neill, fourth edition, chapter number 11, page number 261. Go and read the two statements. True winners don't fall more than 8% below the correct pivot buy point. True winners do not close below the correct pivot buy point. In this week, the stock went below the pivot point, but never closed below it. These two bars, they are not even near the pivot point. Okay. And your selling range, the stock has entered the selling range. So you could probably sell maybe one third of your shares and keep the remaining two third with you as long as the stock remains above the 10-week simple moving average, or maybe sell two third or maybe sell half and keep the remaining half and just ride the stock forward. Okay. So this is, we are already entering 2025. I can't go much forward because of SEBI regulations, but you can check the movement of the stock later. So it starts to fall. This comes on high volume. So that would be a sell signal, outright sell signal. Okay. This would be an outright sell signal because the stock has closed below the average weekly volume. Stock has closed below the moving average on higher volume than the average. So not allowed. This is risky. Okay. So anyway, the stock came to your stop loss. But when you do partial selling, remember one rule with partial selling: when you do partial selling, you have to move your stop loss to break even on the remaining shares. Otherwise, what is the use of doing partial selling? You do partial selling, you make money on some portion of the stock, and then the stock hits your stop loss, you lose money on the remaining part of your stock. So the profit and loss neutralizes, you don't make anything and you just waste time. So remember, when you do partial selling, always move your stop loss to break even. Okay. So look what happened to this stock, collapsed. But before collapsing, let's see how much it went up. So maybe you bought here somewhere. It went up almost 40%. Good. And you probably ended up selling one third, two third, or maybe half here, right? And the red bars came on low volume mostly. Even this is, I think, yeah, below average volume. So not a big deal. Okay. Not a proper sell sign. Normally, a proper sell sign comes on very high volume. But this is very scary, right? In 1 week, the stock falls 12%. So things can happen. Why do you think this happened? Why do you think four consecutive red bars came? Remember, stage base four. Remember, who is selling here? Probably people who bought at base number one, two, three, four. They are the ones who are cashing out, right? So the probability of losing money is more than the probability of making money. For base 4 and base 5, the probability of losing money is 80%. Okay. But the probability that the trend will end, that nobody knows. The trend could continue. The stock might break out of base 4, come down, hit your stop loss, so you lose money, and then again the stock starts to go up, creating base 5, 6, 7, 8, 9, 10. That could happen. Okay. But in late stages, your probability of stop loss getting hit is very high. So that is why for late stage basis, it is recommended to go in with a smaller position size, maybe half of your normal position size. So if your normal position size is 10%, half of normal would be 5%. So you would not put more than 5% of your portfolio in a base 4. no matter how great the stock is fundamentally. Okay. So these are the basics. These are the basic golden principles that I learned from Mark Minervini and William O'Neill. Whatever I have understood based on what I have read and the interviews that I have listened to, I am just sharing that with you. And hopefully, this will add a lot of value to you. When I was researching for this kind of content, I did not find much content except for videos created by Mark Minervini, David Ryan, Patrick Walker. Apart from that, I did not find much meaningful material that would teach me the specifics. So I created this YouTube channel to share my understanding of specifics. That is why I talk about specifics in these kind of videos. This video series, it's like a course in itself. Okay, if you watch these videos, I think this is video number 39. I don't know, maybe I will go till video number 50 because I'm enjoying this video series. I just creating this video series has been a delight for me. I never planned. I thought of ending the series in, 3 videos or 4 videos. Remember, I made one series about fixed deposit versus TREPS. I finished that video series in 3 videos, right? So I thought positional stock trading, I will just teach it in 3 videos. But as students uh, began to take interest, I thought of expanding it. Okay, I thought of covering each and every aspect. And now students who have actually taken interest in this, they say that weekly trading is for much more simpler than daily time frame trading because this is not candlestick chart. This is bar chart, fairly simple. Everything is already marked for you on market smith charts. You don't have to do much. The key here lies in filtering, shortlisting, and stock selection. That's all you have to do. And you have to manage the trade properly, execute it properly, which is what I have covered basically. So, this video series is a course in itself. Okay, so watch this over and over again. It will help you a lot. Plus, just because you are getting value from this YouTube channel does not mean that you stop reading books. See, when you read books and when you watch my YouTube channel, your the knowledge will get cemented in your mind. Whatever is written in the books, it will automatically start to make sense now. Okay, especially Mark Minervini books. Mark Minervini books are it's a legendary uh, manuscript, I would say. It's a legendary book. Okay, it takes like 4 or 5 times of reading to truly understand what Mark Minervini is saying in his books. He looks at the daily and weekly time frame charts. Don't be under the impression that he does not look at weekly charts. He definitely looks at weekly charts. Even his books has got weekly charts. Okay, so pay attention. This is extremely valuable information which I have shared with you. If you combine this with reading books, let's say half an hour every day, if you read books by O'Neill and Mark Minervini, you are done. Okay, in within 1 year, you will notice that your skill has improved a lot. And get market smith. Okay, don't rely on cheap free tools. Okay, be a professional. Treat trading as a profession. Okay, this is not some side hustle or some side income. This is a profession. Okay, some people are doing these things full time, maybe intraday or whatever. I don't know what people do, options and futures and all of that. I don't understand all of that. I understand basic buying and selling, old school way of buying and selling stocks. Very simple. Weekly, daily time frame, swing, positional. Very, very simple. Nothing complicated here. Delivery based trades. You pay cash, you get it. No margin trading, no borrowing, no MTF, no margin trading facility, and all those new products that they are launching these days. Nonsense. Don't get into all of that. Okay. If you have the money, you trade. If you don't have the money, you focus on earning money. You take up a job, start your business, do something in life, earn money, and then come to the market. Till that time, just keep learning. Maybe do some paper trading. If you don't have money, do paper trading, right? When you have the money, you come to the market. Why do you want to borrow from your broker and things like that? Don't get into all of that. Okay. Thank you so much.